Ben ritrovati lunedì mattina su Flood New York Stock Exchange. I leader sono tornati a perdere terreno la seconda giornata consecutiva per lo Standard & Poor's 500. Parliamo dei diversi temi della giornata e della settimana con il nostro ospite, come vedete, Kenneth Polcari, che è responsabile delle operazioni sul floor per O'Neill Securities. Kenneth, ben ritrovato.
Thank you for having me.
So Kenny, a lot is going on today. I would say that we are really looking very closely to the commodities and to gold. Gold has been a story last week, and it's definitely a story today.
We continue to see gold under extreme pressure, all overnight today. We're now down at the lowest point of the day, down 111 points at the moment, which just kind of is in line with the sense of A, gold being overdone, and now B, everyone running for the exit at the same time. And so where is there really some support? And in fact, a lot of people don't think you're going to find real support till you get down to $1,300, which is almost another $100 lower from where we are. So we're going to watch that story as we go on. But the tone this morning was really set out of China last night. China reported, what is to them a disappointing number of GDP growth of 7.7%. For us, that would be a phenomenal number. But, when China's been growing at 8 and 9%, a 7.7% rate is a slowdown. And so that the tone of what's going to happen in Asia, what's going to happen in the Asian region as a result of a slowdown in China, and then what happens in Europe, and then what happens here in the States, and as it's all interconnected, right? We already know that Europe continues to be in a recession, so you have a slowing Asia, doesn't really help Europe at all, and so you see some profit taking, really. You don't see any sense of panic. Our market has been at new highs, really in the face of all this kind of negative news, and so a day like today is certainly kind of welcomed, and it's actually a relief that we're trading off.
And of course, you were saying that everything it's linked, and also, of course, the economic data that we saw this morning from China is not helping the gold and other commodities at the same time. And as you were pointing out today also in your notes, I mean, this movement in the commodities, it's also like a sense that really it's not working. Everything that all the central banks are doing and, to help stimulate the economy is not working. And investors are still afraid about that.
That's right. Investors are afraid about it. And listen, when it first started, right, everyone was really fearful and they ran into gold. And part of the other issue is, let's not kid ourselves, the new products that allow the average investor to really jump in, the gold ETF product, which allows people to jump in and out of the gold market very easily and give them kind of a false sense of security. It goes right to the point, when people really start to get nervous and they start to liquidate, they all run for the door at the same time. And so you see this kind of overreaction. But don't forget, in capitulation, there's always opportunity, right? And so the point is, at what point is it really the opportunity? Is it going to be 1350? Is it right here at 1380? We've seen gold kind of bouncing around here between the lows here and then 1420 all day. And so my sense is, it's still going to go a little bit lower. But the fact is that it does call into question, what about all this stimulus that the U.S. Fed has provided over the last 4 years? Now we see China, we've Europe, Japan, and we've seen what's going on in Europe, and yet the economies are not really taking off.
And here in the United States too.
And here in the exactly here in the United States, because we're watching our macro data once again come in to be mixed to negative. And now earnings reports are right in the throes of earnings season. Last week we saw JP Morgan and Wells Fargo beat on the earnings, but yet they had softer revenue, right? And so they punished those stocks. Today Citibank came out and beat the number again, and Citibank is actually up. But tomorrow we got Goldman Sachs, we got Bank of America coming. We've got a lot of earnings this week, and so the focus is really going to shift to individual company names and then what the future looks like.
Also, especially, the net is going to be interesting, but of course, people want to see revenue level, as you were saying, for the banks, and forecasting from this quarter, the rest of the year, and sequestration effect.
That's right. And so what they want to see is they want to see top-line revenue growth. They don't want to see earnings growing because they're continuing to cut either jobs or expenses. They want to see growing on the top level, and that's where we're stumbling, right? Where we're seeing companies miss. Now, listen, also don't forget is that earnings this quarter are not expected to be stellar. They're actually expected to contract a little bit. The market knows that, and it's still marching to new highs. And all that really tells you is that we as the U.S. equity market, continues to be the safest play if you want exposure to equities, right? If you want to, listen, Treasuries is always the safe play. Everyone thought gold was a safe play, but look at how quickly it's now down 27% from the high, and very, very quick. And so a lot of people have probably gotten hurt on that.
So the defensiveness of the U.S. stocks is pretty obvious. As you were saying today, we are going down, but not that much.
Right.
Some guests I've talked to, they expect a little bit of a downturn during earnings season. So maybe in the next couple of weeks, 2 to 3 weeks, but then we can start again.
Well, then we start again. But I have to tell you that what's very interesting about the U.S. market is every time we back off, 1%, 1.25%, it always finds plenty of buyers. The market stabilizes and once again moves higher. And the sense is that's again what we're seeing. We're only down 0.5% right now overall, the S&P and the Dow, and the market seems to be stabilizing and kind of finding some footing here, which is just about right. I would suspect 1565, 1570 is going to be a place of real short-term support, and I wouldn't be surprised to see the market test that. Again, it's not going to be a major move at all, so nobody should panic about that. But I do think the second half of 2013 is going to be better. I think we will be in a better position. I think the market is telling you that it expects the economy to be in a better position because the market is a discounting mechanism. It's not trading as of what's happening today. It's really trading on what it expects the future to be.
And it could be a deja vu again, all over again. Last year we had the same kind of pattern. April we saw some pressure the year before too. So this could be a pattern, really established pattern for the U.S. market.
Well, it could be, but as long as the Fed continues to stimulate and listen, all the chatter about them maybe pulling out or not pulling out, it's all chatter. As far as we know, Ben Bernanke is committed to stay. He keeps reiterating he commits to stay, no matter what all the other presidents talk about. Well, what they think. The fact is, the Fed chairman has made it very clear that he's here to stay, and so the market knows that, and which is one of the reasons when the market backs off, it doesn't really back off because everyone knows that the Fed is still there and not going anywhere.
And that guarantees the defensiveness
Right.
Of the U.S. market.
Right, exactly.
Well, thank you very much, Kenny, for being with us, and have a great day.
Thank you, and you too.
E grazie a voi per l'attenzione. A domani.